Hi, this is Rowland from Money and Markets TV. As protesters occupy Wall Street, Americans are considering how, or if, they'll be able to occupy the space under this year's Christmas tree. And even though it's not even Halloween yet, retailers are entering the make or break part of the year. So are ETFs focused on consumer-oriented sectors. Today, we'll look at how to enhance your holidays with the right ETF picks. Obviously, we have serious economic problems right now. If you spend a lot of time looking at the headlines or reading blogs, it's easy to get wrapped up in the negativity. But I think it's important to remember two things. First, what people do is more important than what they say. You can ask people a general question like, how do you feel about your financial position? And get plenty of discouraging responses, especially from those who spend $20 a day on gourmet coffee and fast food. Second, most consumer spending comes from a relatively small part of the population. If only 20% of consumers are spending freely, a business that caters to them can prosper. With that in mind, let's look at the latest data from the U.S. Census Bureau. Today, retail and food services spending jumped 7.9% between September 2010 and September 2011. That sounds good, but let's drill down and see why. Gasoline stations, motor vehicle dealers, clothing, restaurants, bars, and non-store retailers like Amazon saw their sales rise. But furniture, electronics, appliance and department stores had almost no growth at all. Based on this report then, it looks like people with spending money are most interested in cars, clothing, and eating out. So here's what I suggest you do. Evaluate each ETF from this sector on its own merits. You can't just buy one with consumer in its name. I have three examples for you of different approaches within the retailing segment. Spider S&P Retail takes the broad-based view. The underlying index draws from the retail components of the S&P U.S. Total Market Index. This ETF gives you an equal-weighted portfolio of the 100 or so largest publicly traded domestic retailers. A luxury store like Saks has about the same allocation as the working man's Walmart. If you think Saks is likely to outperform Walmart, or vice versa, then this ETF may not be what you want. But when you figure that these two companies are really not in competition with each other, having both makes more sense. PowerShares Dynamic Retail takes a different approach. It follows an index that evaluates retail stocks based on criteria like fundamental growth, valuation, investment timeliness, and risk factors. The portfolio is built from the companies with the highest scores. Now, this strategy can adapt to changing trends faster than a passive index-based product. This isn't always an advantage and can even work against you at times. But in addition to its flexibility, another big advantage of this methodology is cost. Computerized stock picking is much less expensive than a human portfolio manager. Retail holders is another one to look at. I normally don't like the way Merrill Lynch designed the holder structure, but when the facts change, I'm willing to change my mind. You see, a few weeks ago, Merrill Lynch struck a deal with Van Eck to transform 6 holders into new Van Eck ETF products. Once this happens, which is supposed to be by the end of the year, most of my holders' objections will go away. The new and improved product will track an index of 25 U.S.-listed companies that derive most of their revenues from retailing. It will be a concentrated portfolio of large-cap retail stocks, representing the top national chain stores. Ultimately, of course, all three of these ETFs depend on consumer spending patterns. All could suffer in the worst-case scenarios. I'm listing them because sooner or later, consumer stocks will be back. I'm Ron Rowland, and thanks for watching Money and Markets TV.